If you watch the financial news, you hear constantly about market volatility, especially in assets like silver. Most casual investors think volatility is just emotional trading. People panicking, buying high, selling low. They think it's a feeling, a mood, maybe a reaction to a Fed speech or some geopolitical drama. They are wrong. Volatility, particularly the kind of sudden sharp spikes we see in precious metals, is not a feeling. It's the sound of the financial plumbing shaking under extreme stress. It's the system struggling to manage its own promises. We need to talk about derivatives, not because they are boring financial instruments, but because they are the single biggest threat and the single biggest opportunity in the modern financial world. And they explain exactly why silver acts the way it does during a crisis. The sheer scale of this is hard to grasp. According to the Office of the Comptroller of the Currency, the OCC, which supervises U.S. banks, as of early 2025, U.S. banks were holding $210.4 trillion in derivative contracts. Let that number sink in, $210.4 trillion. To put that in perspective, the entire U.S. GDP is less than $30 trillion. The entire world's GDP is around $100 trillion. These contracts are promises, not actual dollars, but they dictate who owes what to whom when prices move. These contracts, interest rate swaps, futures, options, forwards, link every major bank, every hedge fund, every dealer, and even major corporations into one gigantic, tightly connected financial web. They are the wiring of the global economy. Now, look at what these derivatives are tied to. About 67% of this astronomical exposure, $141 trillion of it, is tied specifically to interest rate derivatives. Think about that. Every time the Fed makes a policy decision, every time market expectations shift on inflation or growth, it changes the value of $141 trillion worth of contracts. Every rate move instantly changes who owes money, who gains, who loses, and most critically, who must post collateral. This leads us to the concentration problem. A system this huge might be manageable if the risk were spread out, but it isn't. The OCC data reveals a horrifying concentration of risk. 4 banks, just 4, control over 86% of all derivative exposure in the U.S. system. We are talking about institutions so massive, so interconnected, that their failure is quite literally unthinkable. If one of them goes down, the entire $210 trillion web snags. What this concentration creates is a paradox. The system is incredibly efficient during normal, calm times. Trades are executed quickly, risks are theoretically offset. But under stress, it becomes extremely lethally fragile. If you have watched any disaster movie, you know the principle. A skyscraper is stronger if it sways a little in the wind. A rigid structure snaps. This system is rigid because those 4 banks are like 4 massive pillars holding up the entire global financial roof. So how does this fragility translate into sudden market movements? It comes down to collateral. When markets are stable, banks and counterparties can net their positions. If Bank A owes Bank B $1 billion, but Bank B owes Bank A $900 million, the net exposure is only $100 million. This netting is crucial for keeping the system functioning. But when prices start moving fast, when volatility hits, those net exposures suddenly explode. The OCC estimates that even after all this netting, there is still about $252 billion in real credit exposure that must be collateralized immediately when the markets move against the losing side. And here is the critical point, that collateral must be posted in cash, and it must be done immediately. This is margin call territory, but on a systemic banking level. Imagine the scenario. Interest rates suddenly spike higher than expected. One of the 4 giant banks is on the losing side of a massive $5 trillion swap contract. Suddenly, they owe cash, real, immediate cash, to their counterparty to cover the new exposure. They don't have $10 billion in immediately accessible cash sitting under a mattress. They need to raise it fast. This is where volatility becomes dangerous, and this is where silver enters the story. When a major institution needs to raise billions of dollars instantly, they don't sell their best assets. They don't sell the core of their business. They sell whatever they can sell most quickly, efficiently, and with the least drag on the market price. Often assets they hold in reserve or simply assets that are highly liquid and tradable. They must sell something. During the 2008 crisis, institutions sold everything that wasn't bolted down, including massive positions in gold and silver, even though those assets were supposed to be safe havens. Why? Not because gold and silver were bad investments, but because they were highly liquid forms of collateral that could be immediately converted to the cash necessary to cover derivatives losses elsewhere in the system. This dynamic explains the paradox of silver's volatility. When financial stress mounts, there are 2 competing forces acting on silver. Force 1, the flight to safety. People and smaller institutions want real assets like silver because they see the fragility in the banking system. This drives prices up. Force 2, the forced liquidation of collateral. The megabanks, needing immediate cash to cover massive derivative margin calls, must sell highly liquid, unencumbered assets, which often include physical silver and paper silver contracts. This drives prices down. Which force wins? In the initial sharp phase of a financial earthquake, the need for cash, force 2, often wins temporarily. That is the violent sudden dip you see. It looks like a crash, but it's really just the system coughing up collateral. But once that initial liquidity requirement is met, the underlying stress remains. In force 1, the realization that the financial promises are unsound takes over, driving the price of real assets like silver higher, often violently higher, because the market has just proven how incredibly fragile the plumbing really is. Understanding that volatility is not emotion, but a function of systemic fragility and the immediate demand for collateral, completely changes how you view opportunities in precious metals. It means the dips are often driven by mechanical selling, not fundamental weakness. We are living in an environment where the derivative risk is higher, more concentrated, and more vulnerable to interest rate shocks than perhaps ever before. That $252 billion collateral requirement is the tripwire. When it gets hit, somebody's going to have to sell something. Knowing this mechanism allows you to see the true nature of financial risk, and helps you prepare for the inevitable structural volatility that is baked into a system reliant on $210 trillion worth of promises. Stay informed, stay strategic, and be ready to act when the system starts shaking. Thanks for watching. Be sure to subscribe if you want to keep peeling back the layers on how the global financial machine truly works. All right, let's talk about silver. Specifically, why the price you see flash across your screen might have absolutely nothing to do with supply, demand, mines, factories, or solar panels. We need to understand that silver sits at a unique and highly volatile intersection of three powerful forces: extremely high leverage, massive liquidity, and genuine real-world scarcity. Now, let's drill down into that leverage. This is the key difference between the paper market and the physical market. A single COMEX silver futures contract controls 5,000 ounces of metal. At today's prices, that's roughly $450,000 worth of silver, all tied up in one contract. But here's the kicker. To control nearly $500,000 of metal, a typical trader only has to put up maybe $20,000 to $30,000 in initial margin. Think about that ratio. That is 10 to 15 times leverage. You're betting $10 or $15 for every $1 you actually own. This allows huge amounts of capital to flood the market very quickly. This massive leverage is fine when prices are stable, but it becomes a structural vulnerability when volatility spikes. And who controls that volatility switch? Often, it's the CME group, the exchange operator. When volatility rises, perhaps after a strong rally like we've seen recently, the CME has a standard operating procedure. They raise margin requirements. They demand more cash collateral per contract to offset the increased risk. If you were required to put up $25,000 yesterday, you might be required to post $35,000 today. For large traders who are already maxed out on their leverage, this is a major problem. They suddenly have to come up with tens of thousands of extra dollars for every contract they hold, or they are forced to sell their positions to meet the new requirement. They don't sell because they changed their mind about silver's long-term value. They sell because they have no other choice. This forced selling creates what we call a cascading liquidity event. As positions are liquidated, prices start to fall. When prices fall far enough, stop losses, those automatic sell orders, get triggered. More selling accelerates the decline, triggering more stop losses, creating a downward spiral. The price drops not because there aims a new giant silver mine opening or because industrial demand evaporated overnight, but purely due to a mechanical, financial mechanism driven by margin calls and leverage. This is not theoretical. We saw a perfect example of this mechanical collapse on a specific day in the not-too-distant future, December 29th, 2025. That day, silver futures fell nearly 9% in a single session. What caused it? A few days prior, silver had been on a strong rally, generating enthusiasm. The CME, seeing the increased volatility and the rising risk exposure of the exchange, stepped in and dramatically raised the margin requirement for silver futures. Leverage immediately collapsed, triggering massive mandatory selling. The paper price of silver tanked. But here is where you see the profound disconnect. While the paper price was free falling, what did the physical market do? Absolutely nothing. If this had been a true fundamental collapse, if industrial demand was gone, or mines were flooding the market, you would expect physical dealers to slash premiums, delivery times to shorten dramatically, and inventory to suddenly flood the market. None of that happened. Premiums for physical silver stayed firm. If anything, they got tighter because smart money saw a buying opportunity. Delivery times did not improve. Inventory did not flood the shelves. Paper silver collapsed, completely disconnecting from reality. Physical silver, the real metal, ignored it. That tells you everything you need to know. That massive 9% drop was purely mechanical. It was a margin call event, a deleveraging event, manipulated by the structure of the financial market, not by the fundamentals of the physical asset. Understanding this dynamic is crucial for anyone investing in silver. You need to look past the day-to-day volatility of the highly leveraged futures market and focus on the real fundamentals. The increasing industrial demand for green technology, the shrinking above-ground physical stockpiles, and the constrained mining output. Don't be fooled by a paper crash driven by bankers and algorithms. Focus on the scarcity of the metal you can hold in your hand. If you found this breakdown of paper versus physical silver helpful, make sure to hit that like button and subscribe for more deep dives into market structure. Thanks for watching, and I'll see you in the next video. Have you ever watched silver prices suddenly plummet for no obvious reason? It can be terrifying, right? But what if I told you that most of those massive unexplained silver drops aren't about silver at all? They're about the financial system breaking down, and silver is just the canary in the coal mine. We're going to dive deep into a core truth about silver that the mainstream financial media completely misses. Understanding this truth won't just save you from panic. It will reveal massive opportunities when everyone else is forced to liquidate. Right now, two entirely different silver markets are operating simultaneously, and they couldn't be further apart. On one side, we have the paper market. This market is dominated by derivatives, massive margin requirements, liquidity stress, and forced selling. Think of massive institutions trading futures, contracts, and options, dealing in promises, not metal. On the other side, we have the physical market. This market is driven by actual metal, industrial demand, dealer inventory, and real-world delivery times. This is the market where you buy a tangible silver coin or bar. Here's the critical point. These two markets can diverge sharply, especially during times of financial stress. When you see silver prices crash, meaning the paper price drops significantly, you need to immediately stop and ask yourself three crucial questions. These questions determine whether you're watching a true collapse in demand or simply leverage being flushed out of the system. Question 1, did margins rise? If the exchange dramatically increased the margin requirements, meaning the collateral needed to hold a futures position, that is a massive signal of forced liquidation. Traders who are highly leveraged suddenly have to pony up more cash or sell their positions, regardless of their belief in the metal's value. It's a collateral call, not a value assessment. Question 2, did physical premiums fall? When the paper price collapses, you must check what dealers are actually charging for physical coins and bars. If the paper price drops 10%, but the premium you pay to actually buy a physical ounce stays the same, or more often, or rises, then the move is purely paper only. The actual demand for tangible metal hasn't gone anywhere. In fact, people are rushing to secure what they can at the artificially lowered price. A true collapse would see dealers discounting physical metal to move inventory, and that simply does not happen during these flash crashes. And question 3, is the derivatives system under stress? If yes, it means silver is being sold in massive quantities, not because people hate silver, but because it's the easiest or most liquid asset they can sell to raise the necessary collateral to cover much larger losses or margin calls elsewhere in the financial system. Think of a massive hedge fund that is over-leveraged in junk bonds. When the junk bonds start failing, they need cash, and they sell their silver futures contracts because they are liquid, even if it means taking a temporary loss. When all three of these signals align, margins are up, physical premiums hold firm or rise, and the wider derivative system is showing stress, you're not watching a collapse in silver's value. You are watching the global promise chain breaking under the crushing weight of leverage. This leads us to the core truth that governs modern finance. The entire system runs on approximately $210 trillion worth of promises. These promises are derivatives, credit default swaps, leveraged bets, and complex financial instruments. They are agreements on paper that asset values will hold up. Silver is one of the very first places where those trillions of dollars in paper promises crack when serious stress hits the system. Why silver? Because it's relatively liquid, it's traded globally, and it's a small market compared to other major commodities. When the financial system needs to deleverage fast, the paper claims on silver get obliterated. Paper can print infinite claims on silver, but a bar of silver cannot print itself. If you understand this dynamic, you gain a massive advantage. First, you can ignore the panic. When you see the paper price drop 15% and your friends are freaking out, you check the physical premiums. If they're rising, you know the paper crash is meaningless to the long-term value of the physical asset. Second, you recognize the opportunity. When highly leveraged traders are forced to liquidate their holdings to satisfy margin calls, they are selling metal. They don't want to sell at prices that don't reflect true supply and demand. this is the moment to accumulate. You are buying physical assets at an artificially depressed price from someone who is being forced out of the market by systemic financial rules, not by a change in silver's utility or industrial demand. This isn't speculation. This is preparation. Speculation is betting on a price move. Preparation is acquiring real wealth when leveraged paper promises fail. The next time silver crashes on no news, remember those 3 signals. That crash is not a red flag saying the asset is failing. It's a giant neon sign screaming that the financial system's over-leveraged promises are failing, and that is your cue to step in. If you found this breakdown valuable and want more insights on how physical assets protect you from paper market failures, please like this video, subscribe to the channel, and hit that notification bell so you don't miss our next deep dive. Thanks for watching.